All right, let's start. So thank you for joining us today. We're going to spend the next 30 minutes or so explaining how to dissect a letter of intent and negotiate it to your advantage. For many founders, receiving an LOI or letter of intent is one of the most exciting moments in their journey. After years of building the business, someone is finally saying in writing, "We want your business." It's validating. It's exciting. It's often the moment where selling the business suddenly feels tangible and within reach. And that point is exactly why so many founders make poor decisions. The excitement and the emotion of receiving an offer can cloud the judgment needed to evaluate it properly. Excuse me. Yeah, sorry about that. So, an LOI needs to be thought of as a proposal that determines how much you receive, when you'll receive it, how much you'll risk, how much you retain, and how much you give away before the deal is actually done. The decisions made over the next few weeks from that point after you sign quite literally change the outcome of the transactions, can change the outcome of the transaction by millions of dollars. So today's webinar is about making sure that doesn't happen. We're going to start by understanding what an LOI actually commits you to, because many founders misunderstand what they're signing. From there, we'll look at how to evaluate the commercial terms beyond the headline valuation, how to identify the risks hidden in the structure, timing, exclusivity, and finally how to negotiate before you hand the buyer the one thing that they want the most, which is exclusivity and leverage. So by the end of the session, our goal is simple. We want you to be able to pick up any letter of intent, understand where the value is being created, where it's lost, and how exactly, what exactly needs to change before you sign it. My name is Elie Youssef. I'm a director at Venero. I joined at the turn of the year. Before that, I was with another investment bank. Before that, two-time founder myself with two exits, technology companies. Both incredible experiences. I made a lot of mistakes as a founder. I tried to run the process myself. I didn't hire an advisor, but lots of lessons learned, and now enjoy spending my time with Georgios and the team, helping founders and CEOs like yourselves maximize their exit. So I'd like to hand over to Georgios to give an introduction to himself and to the firm.
Yeah, thanks. Thanks, Elie. It's nice to be here again. Fourth iteration of this, of the series. Today talking about LOI, something a bit more, not necessarily overly technical, but a bit more specific. And again, loads of lessons and tips and tricks and do's and don'ts when it comes to LOIs. A bit about my background. So I've been now with Venero for almost 10 years. Before that, I was at Deutsche Bank and Morgan Stanley doing M&A across a number of sectors. And started my career in New York back in the late 90s. And now with Venero, we've been focusing on maximizing exits for founders. I can also say a bit about Venero for those of you who don't know us. So at Venero, we're an investment bank offering three types of services for founders. The first one is M&A advisory. That's the bread and butter of what we do, helping founders achieve exceptional exits. We also support founders with equity financing advisory and debt financing advisory. I think one of the things that kind of sets us apart, I would say, is that our senior teams and our senior bankers are, first of all, hands-on. So we don't pass on the transaction to juniors, right? So we stay on as lead for the process, for the deal throughout the process. The majority of the folks are either ex-investment bankers from banks like HSBC, JP Morgan, Credit Agricole, Rothschild, or from operators like Elie and others who have been at the trenches, operated companies, exited them, or advised on exits, and now we're doing the same thing as part of Venero. In terms of our geographical coverage, so we have folks sitting across a number of cities, and we run mandates globally. So from Australia and Southeast Asia to across Europe, North America, South America, and in fact, a lot of the transactions that we do are cross-border transactions. So we find that in most situations, the buyer ends up being from outside the market where the company is based. And then in terms of deal sizes, we focus on the lower and mid market. So deal sizes from the low tens of millions to a few hundred million is a sweet spot. And across sizes, segments, geographies, we've done that. So happy to pass that on to Elie and share with you guys some of the tips, to do's and don'ts for LOIs today.
Yeah, thanks, Georgios. So what the webinar covers today, we'll start at the very top. We'll start by understanding what a letter of intent actually is, and just as importantly, what it isn't. There are a lot of misconceptions around what founders are committing to at this stage, and getting that wrong can create problems later in the process. From there, we'll look at how to evaluate the economics behind the headline valuation. We'll separate enterprise value from what ultimately reaches the shareholders, and discuss why structure can often be more important than that headline price. We'll then cover the areas where buyers most commonly reopen negotiations. We'll look at those, how those risks arise, and more importantly, what you can do before signing the LOI to minimize the chances of a retrade. Finally, we'll bring it all together by looking at how to negotiate before granting exclusivity, because that's often the biggest shift in leverage during a transaction. Once you understand what you're giving up and what you should expect in return, you'll approach that decision very, very differently. So by the end of the session, you'll have a practical framework of reviewing an LOI with the same mindset as an experienced M&A advisor. So before we start, let's establish exactly what an LOI is and what it signals. For many founders, this is one of the most exciting documents they receive during a transaction. It's the first time a buyer commits their intentions to paper. It's also one of the most misunderstood documents. A letter of intent is the buyer's formal proposal to acquire your business. In most cases, it's not legally binding, actually in pretty much all cases. And it's not an obligation to complete the acquisition, but what it does is it establishes the commercial framework for everything that follows. It's a document that you can go back to later in the M&A process, and to which you can hold the buyer accountable to an extent. It's by no means the finish line. It marks the point where the process shifts from a competitive market exercise, where you're speaking with multiple buyers, to bilateral negotiation with only one buyer. Everything before exclusivity, which we covered in the first 3 webinars, is about creating leverage. Everything after exclusivity is about protecting that value and guarding against leakage. So by the time you receive an LOI, you've already been through buyer outreach, you've had management presentations, product demos, you've reviewed indicative offers. The buyer's invested time in understanding the business and is now prepared to put forward a formal proposal. So that makes this one of the most important documents in the entire transaction. If key commercial points aren't agreed, then they become significantly harder to negotiate once exclusivity has been granted to a buyer. And it's important not to fall in the trap of over-negotiating and getting lawyers involved too early with an LOI, and that's really where deal experience becomes invaluable. So essentially, looking at this slide, a good LOI should answer these 6 questions. The first is, what's being acquired? Is this a full acquisition? Is it a minority investment, or is it a recapitalization? Is it a share or an asset sale? The distinction between these 2 alone can have significant impact on taxation and the amount that you ultimately walk away with. So before discussing value, you really need to understand exactly what transaction is being proposed. The second question is, what's the basis of the transaction? What's the transaction basis? Is the offer on a cash-free, debt-free basis? What assumptions have been made around cash and working capital? Small differences here can make a massive difference in the proceeds and what you receive at closing. The third is, what is the enterprise value? It shouldn't be a valuation range. It should be a single number that the buyer is prepared to stand behind. The fourth is how and when is payment made? How are you going to get paid, and when are you going to get paid? Is the consideration all cash at closing? Does it include rollover equity? Is there deferred consideration? Is there an escrow? Is there an earnout? Two offers with the same headline valuation can produce very, very different outcomes depending on how that deal is structured. The fifth is how will the transaction be funded? Is the buyer using their own balance sheet? Are they relying on external debt or investor capital? Funding tells you a great deal about the execution risk and the probability that the buyer can close. What internal approvals has the buyer obtained, and what approvals are still needed? And then finally, what happens next? Exclusivity, diligence, approvals, the signing timetable, and the proposed role of the founders all shape how the process unfolds from this point. So throughout the rest of this webinar, we'll talk you through each of these areas in detail. We'll show you how experienced advisors read beyond the headline valuation to how they assess the true quality of an offer, and then what you can do to protect value and guard against leakage and retrades.
So I think one thing one way I would frame LOIs at a high level here is a common understanding between a buyer and the seller about the transaction. Now, the more detailed that level of understanding, the more the transaction is de-risked and the more surprises you get down the line, and the fewer items you need to negotiate down the line. Yeah. So that's the way to think about the LOI. It's not the end, it's not the beginning, it's somewhere in between. It marks the kind of the termination of the marketing phase of the business and the beginning of the due diligence. But the LOI itself is a milestone in a document that reflects the common understanding that the two sides have up to this point. The broader the understanding and the deeper the level of that understanding, the better. And we're going to go through today what are the various aspects that are very important to level set on at this stage.
Yeah. So you received an LOI. What happens? What should you do next? The first thing you should absolutely do is get a second opinion, an expert opinion. If you don't have an advisor, it may be a good time to reach out to one. But beyond that, the following section will help you think about the next steps and the questions that you need to be asking. So before reacting to a price, you need to establish exactly what the buyer is proposing to acquire. It sounds obvious, but founders regularly compare offers that are economically very, very different. The first question is, what's being sold? So in most software transactions, the buyer acquires shares in the company. In other situations, they may acquire selected assets or intellectual property, contracts, or specific operating entities. That distinction matters because the tax treatment, liabilities retained by the seller, and post-closing obligations can be very, very different. The second question is how much ownership is changing hands? Is the buyer acquiring the entire company, a controlling stake, or a minority interest? $100 million valuation for 100% of the business will produce a very different outcome from a $100 million valuation where the buyer acquires 60% and, for example, expects the founders to retain the balance. What you also need to do is you also need to distinguish between primary and secondary capital. Primary capital goes into a company to fund the growth. Secondary consideration goes to the existing shareholders. A minority investment may carry a strong headline valuation, while providing relatively little personal liquidity to the founders. And then the third question is, what does the founder retain after completion? That may include rollover equity, broad representation, minority protections, rights around a future exit. It may also include obligations to remain with the business, might have restrictive covenants or performance commitments. So retained equity can create meaningful upside, but the founder will usually have less control over how the business is operated and when the next liquidity event occurs. So before comparing valuation, the top line, make sure you're comparing the same transaction, the structure. You need to understand what's being acquired, how much ownership is changing hands, what rights, risks, and obligations remain with the founder, and only then can you assess whether the price is attractive or not. So translating EV into seller proceeds. This is always interesting. The next step is how you translate the enterprise value into the amount that the shareholders are ultimately going to receive. So founders might often see that the offer of 75 million and assume that that's the amount that they will receive. 75 million is the enterprise value. You still need to work through the equity bridge. So the first thing you need to do is clarify the assumptions around cash, debt, working capital, and any other deductions. If the transaction is cash-free, debt-free, you begin by adding surplus cash. So if you look at this example here on this table, then you deduct debt-like items, and any working capital shortfall. So in this example of the 75 million business, what the founders or what the shareholders walk away with is 69.5 million of equity value before transaction expenses, tax, or any deferred consideration is taken into account. So the definitions absolutely matter. Cash may include money sitting in the bank, but restricted cash or cash required to operate a business may be treated completely differently. And debt is also broader than just bank loans. Buyers may seek to include leases, shareholder loans, unpaid bonuses, or leave, tax liabilities, or other items they believe should be settled by the seller. Working capital creates another big area of negotiation. The buyer will expect the company to be delivered with a normal level of working capital, but if the actual amount at closing falls below the agreed target, the purchase price usually is reduced by that amount. So the seller owes the buyer that shortfall. That's why the LOI should establish the transaction basis, the working capital methodology, and the treatment of material debt-like items. The final figures may only be available at closing after diligence, but let's say the rules of governing the calculation or the framework should be clear before you give exclusivity to the buyer. So just to summarize, a strong headline valuation can lose substantial value through an equity bridge that was left vague at the LOI stage.
Yeah, and I think another thing that people don't often realize is that these deductions are taken out of the cash portion of the consideration. If there's a combination of cash versus shares, then this is taken out of the cash portion, and then people just don't realize that they're left with higher percent of shares if it's than they had originally seen at the headline in the LOI.
All right, so once you've established the equity value, the next question is, how that value is actually delivered. So a 75 million offer may sound straightforward, but the consideration can be split across several components with very different levels of certainty, right? So in this example, 55 million is paid in cash at closing. That's the most certain part of the offer and provides immediate liquidity to the shareholders. The next 5 million is held in escrow or paid on a deferred basis. The amount may be fixed, but the timing and the recoverability still matter, and they need to be defined. They need to understand the release conditions, the duration of the holdback, whether the buyer has the financial capacity to make the payment when it becomes due. Then another 10 million sits in an earnout. That value only becomes payable if agreed performance conditions are achieved. The definitions, measurement period, the buyer's ability to influence performance become critical once the founder no longer controls the business. So those need to be clarified. And actually, we have I think it's the 6th webinar in the series where we focus on how to structure earnouts. The final 5 million is rollover equity or shares in the buyer. So that might create future upside, but it remains illiquid and exposed to dilution. If they raise again, it's exposed to governance and the timing of the buyer's next exit. So the assessment comes down to essentially to these 3 questions. How much of it is certain? How much of the consideration is certain? When is the balance paid? And who controls the outcome? So a founder or CEO should absolutely understand the probability adjusted value of every component before just judging the overall offer. How to avoid retrades. So a retrade is often based on something that was left vague in the LOI. The buyer may have, they might have offered a strong valuation, but that valuation often depends on assumptions around revenue, profitability, working capital, or the condition of the business. And they never really know until they do full diligence. So if those assumptions are not recorded, the buyer can revisit them during the diligence process. So if you take forecasts, for example, if the offer was based on the company delivering a particular level of revenue or EBITDA during the period of the M&A process. So first and foremost, make sure you're highly confident that you'll be able to deliver anything before you agree to it. And establish an understanding that there won't be a retrade if the metric is not exactly met, and what buffers there are to mitigate. Something similar still applies to working capital and debt-like items. Those items will be diligenced later on in the process and negotiated very heavily, very contentiously. But you as a seller have the most leverage pre-exclusivity. So with that in mind, and obviously to the extent possible, try to at least agree in principle how certain large items, the material items, for example, deferred revenue, will be treated. If the methodology is left open, the buyer usually, kind of acts on that vagueness, and they may introduce additional deductions later when the negotiated leverage has shifted to their advantage. So vagueness around the area is to their advantage and usually works against you, the seller. So the other one is the known risks should also be dealt with before signing. So, for example, if there is a customer concentration issue, tax exposure, or technical weakness has already been disclosed, the LOI should reflect how those issues have been treated or are going to be treated. You don't want the buyer pricing the same risk twice. So, or even worse, pulling out because the risks weren't adequately highlighted and acknowledged beforehand. And then the final area is diligence scope. Broad subjective conditions give the buyer room to treat minor findings as material. The seller should define the key work streams, apply sensible materiality thresholds, and require issues to be raised within the agreed timetable. You can't eliminate every retrade risk, but you can remove, as many of the openings as possible that a buyer might leverage. So the more clearly the LOI records the assumptions behind the offer, the harder it becomes to reopen the economics once you've granted that buyer exclusivity.
Yeah, and look, it may be helpful to frame the LOI within the context of the broader M&A process. Yeah, so the LOI almost sits at the middle, or between the marketing phase, right, where value is created for the business for the business vis-a-vis the buyers. Yeah, so during the marketing, you try to build up the value and the valuation of the business, and then post LOI, once you go into exclusivity, you're basically trying to maintain the value that you've built and that you've agreed at the LOI stage, right? So you're building LOI and then you're maintaining. Now, the LOI is your best chance to capture and crystallize a lot of these open items, and there's a lot of them. And okay, to be fair, every situation is different. Some buyers will be willing to agree or specify more of these items. Others may push back and say, look, some of these items we'll need to discuss during diligence. For you as a seller, it's important to understand that your negotiating leverage shifts post exclusivity. So once you've signed an LOI, the negotiating leverage shifts. That's why pre-signing of the LOI, right, and pre-exclusivity is your best chance to create a common understanding across as many of these points as possible. Okay, and okay, for some of them, you may not be able to get an exact, precise agreement. So working capital, for example, okay, the buyer may need to do proper financial due diligence before they can agree on every single item of the net working capital adjustment. But still, there are some big items, or there may be, depending on the situation, some big items on which you want to at least establish a framework, right, or a general understanding of how these will be treated. And the best chance for you to do this is pre-exclusivity, right, at this LOI stage, where you still have stronger negotiating leverage. Even if it's just a framework, even if it's just a common understanding, because none of this is actually legally binding, still now is your best chance to negotiate as many of these as possible and de-risk the rest of the process.
That's great context. Okay, so if you've run a competitive process properly, hopefully you've taken something away from the first three webinars. By this point, you should have more than one bid on the table. That matters because an LOI is much easier to assess when you can compare it against a real alternative rather than judging it in isolation. And if you look at this, these two examples here, at first glance you might think that you might be drawn to offer A. The headline value is $10 million higher, so it immediately feels like the stronger proposal. But once you look at the structure, the picture changes. Offer A delivers $50 million cash at closing. The remaining 35 sits in an earnout and rollover equity. So a meaningful part of the value depends on the future performance, continued involvement, and a later liquidity event. The buyer also still needs financing and investment committee approval, while also asking for 90 days of exclusivity and kind of broad diligence. Offer B, on the other hand, has a lower headline value, but it delivers 60 million cash at closing. It's fully funded. It's been board approved, has a shorter exclusivity period, and more clearly defined diligence milestones. So neither offer is inherently good or bad. The right answer really depends on, or the right offer really depends on the founders. A founder who still believes strongly in growth, wants to remain involved, is comfortable taking on that risk for greater upside, may prefer offer A. A founder looking for liquidity, certainty, and a cleaner exit may place more value on offer B. Where you are in your life matters, where you are in your journey matters, your financial position, family commitments, your willingness to stay for another 3 to 5 years, for example, and the appetite for further risk all influence the decision on which LOI to choose. And that's why we always say that board and co-founder alignment is very important before the LOIs arrive. One shareholder may want maximum cash at closing, while another may be willing to roll over equity and pursue a larger second bite of the apple. The main point is that structure can matter more than headline price. The headline shows the maximum stated value. The structure tells you how much you receive, when you receive it, and importantly, how much risk remains with you after closing.
Yeah, and then here there's this whole thing, excuse me, on the length of exclusivity. And one question we received was, okay, what's a reasonable length for the exclusivity period? And here we have 90 days, 45 days. And the reality is twofold. Firstly, exclusivity, it tends to get extended. Yeah, so you may start with 90 days or 45 days, and then you would extend it anyway. But secondly, it's tricky to say, well, 45 days of exclusivity is better than 90 days, because at the end of the day, once you go into exclusivity with a buyer, you need to go to all the other parties and tell them that, okay, we are going to go into exclusivity with a particular party and we cannot continue the conversations. Yeah. Once you've done that, even if the exclusivity period is relatively short, it's hard for you to recover from entering the exclusivity and then exiting it. Yeah, it's hard to recover. It's hard to create a narrative as to why, after going into exclusivity with a particular party, that transaction ended up falling apart, and now you're back talking to everybody else again. It's not impossible, but it's hard to find a narrative that will give you the same negotiating leverage as before. So rather than worrying about the length of the exclusivity period, I think it's better to ensure that before you go into exclusivity, you do all the things that we are discussing here, and you de-risk the process post-exclusivity as much as possible.
So once you've compared the offers, the next step is deciding how to counter them. So a common mistake is to negotiate in parts, each item separately. Founders might push on valuation, then move to earnout, then rollover, then payment timing. The buyer responds to each point in isolation, and that's where value can quietly move from one part of the package to another. So you start to get that leakage. The better approach is to look at the LOI as one connected commercial outcome. So before responding, get aligned with the board and the shareholders, your co-founders, on what matters, which terms are non-negotiable, which ones you can move on, where you're prepared to accept more risk in return for greater upside, for example. And that will vary between different people. One shareholder may prioritize cash at closing, like we mentioned. Another may be comfortable taking rollover equity because they believe strongly in the next phase of growth. Someone else might accept an earnout, but only where, for example, the targets are objective and the buyer can't change the business in a way that makes them harder to achieve. And that's where trade-offs come in. You might accept a lower headline value in exchange for more cash at closing. You may accept an earnout, but only with clear measurement rules, proper protections, and and the ability to influence the factors that drive that performance. You might accept more rollover equity in exchange for stronger governance rights and a clear route to future liquidity. Where consideration is fixed but deferred, the focus will then shift to security, shifts to payment dates, and what happens if the buyer doesn't pay on time. So the important point is to understand what you're giving up and what you're receiving in return. I would also counter the full proposal in one coordinated response that shows that the buyer what an acceptable package looks like across value, across structure, process, rather than creating a long series of disconnected, drawn-out negotiations. And while those discussions are taking place, you obviously keep the other buyers engaged. You're negotiating with them as well. Competitive tension gives you options and makes your position more credible. Also gives you more confidence in your negotiations. But the overall objective is to secure the best overall combination of value, certainty, risk, and control for the shareholders. And that, as a founder and CEO, is your fiduciary responsibility.
Yeah. And look, I mean, negotiations and that's a course in and of itself, right? So experience is very important in these in this particular situation. But broadly speaking, I think what Elie mentioned about negotiating the package as a whole is generally important. There are, of course, exceptions, right? So if you're in a position of strength, maybe a sequential negotiation to some extent can be beneficial. But as a rule of thumb, that can create a bit more tension. And if you're able to negotiate everything as a whole, that's generally that can be to your advantage. It's very important to communicate, as Elie mentioned, openly and clearly your priorities, because there are a number of things that can be discussed and agreed upon as part of the LOI stage. It's important if you're working with an advisor, for your advisor to know those things, and then they can make a judgment call on how to present these to the buyer, which parts to push on, which ones to yield on, and how to get you to the desired outcome. I remember I had a conversation recently with a founder who said, "Look, our objective is to achieve that X. This is where we want to get to." Now, we were in agreement on, okay, this is our objective. The question was, how do we get to that objective? And sometimes to achieve a certain objective, right? In this particular case, the objective was we need to close as quickly as possible, right? In some cases, the non-obvious path can get you there quicker or with greater certainty, right? So again, everything is dependent on the particular situation and the particular priorities that you and your board have. So yeah, that's why, again, like I mentioned, experience matters, and being able to keep everything into perspective can help you get on balance the optimal outcome.
That's right. So the exclusivity exchange. This is another interesting one. And founders often give away exclusivity far too easily, particularly when the conversation starts with a unsolicited inbound. We see this a lot, unfortunately. So someone approaches you, says they admire the business and they want to explore an acquisition. You're currently not running a process. It comes out of the blue. It can be incredibly flattering, especially if, selling the company, as I mentioned, wasn't on your agenda. But buyer interest doesn't mean the buyer has earned exclusivity. The way I think about exclusivity is very simple. The seller is giving up leverage, right? So if you run a competitive process, up to this point, the buyer knows there may be other parties in the process. That creates pressure on price, it creates pressure on terms and conditions. Once you sign exclusivity, that pressure evaporates. So you're effectively now only backing one buyer. You stop engaging with alternatives. Management focuses on their diligence process, and the whole transaction starts moving on the buyer's timetable. That can be the right decision, but only once the buyer has earned it. So before exclusivity, I would want to maintain. I want to make sure that the main commercial points are settled around valuation structure, how the consideration is being paid, the treatment of cash, the treatment of debt, working capital. All of that should be clear enough that we're not going to reopen them halfway through diligence. I'd also want comfort around how the buyer plans to fund the deal and what approvals are still outstanding. Look, you're not likely to get formal proof of funds at this stage, but you should understand whether the offer relies on new debt, whether it relies on an investment committee, board approval, or another capital raise. And the diligence plan also matters. What's left to review? Who's doing it? How long will it take? What could realistically change the agreed terms? Then you control the exclusivity period itself. You keep it short. You put dates against key milestones. You avoid automatic extensions. If the buyer needs more time, they should be in a position to show real progress and then justify the reason for extending. But the practical point is this: once you give up competitive leverage, you need a buyer who's committed, who's organized, and who's moving towards closing on a clear timetable.
Yeah, and look, I mean, here we are presenting kind of the ideal scenarios. Yeah, what you should pursue, what you should go after, how the LOI should be structured, and all the areas that should be agreed upon and de-risked. Now, of course, you need to understand in every a particular situation can be anywhere between a very straightforward, swiftly moving buyer who will agree on all these things, who will do a bit more diligence up front, and be able to provide you the comfort that you need, all the way to a party that may change their mind, change their position, even if some parts were agreed at the LOI stage, right? They might refuse to agree certain things at the LOI stage. So everything in between. Yeah. And these things are not necessarily malicious, right? These are people we're dealing with, and things change, and there's dependencies that on the buyer side that you as a seller may or may not be aware of. They may have LPs or debt funders or others that they depend on, investment committees, new committee members. So things change, things can get complicated. But you're as a matter of principle, the LOI is something that you can use during the second part of the process. Even though it's not legally binding, at the very least, it can make things smoother. And if things change, which they may, at least you should have someone as your advisor, someone who can use what was discussed at the LOI stage, who can use that to your advantage in order to negotiate a better outcome should the unexpected happen. Yeah, so it's always better to say, look, we agreed on this treatment for net working capital, and try to hold them to it rather than not having discussed it at all. So at least know how to use the LOI and what was agreed at the LOI stage for when things for when things change, if they change down the line.
So before you sign, by this point, ideally you've assessed, other offers, you've assessed this offer, you've broken it down, you've compared it against alternatives, you've negotiated the package. But before anyone signs, I would pause and run one final review with the board and the other shareholders and the advisors of the group. Start with the transaction itself, make sure everyone understands exactly what's being sold, how much ownership is changing hands, what equity remains, and what the founders are expected to do after completion. Then work through the economics. The enterprise value needs to convert through a clear equity bridge. the treatment of cash, debt, working capital, and any other material deductions need to be properly understood. You should also know exactly how the consideration is being delivered, so how you're getting paid, how much is getting paid at closing, how much is deferred, what's conditional or rolled into the buyer, and what risks remain around each component. That's very important. And the buyer's position, matters as well. You need a credible understanding of their funding source, their internal approvals, the remaining diligence of any, and the conditions that still need to be satisfied. Then you have to review exclusivity carefully. How long does it last? What progress is expected during the period? What happens if the buyer misses deadlines, slows the process, or tries to change the agreed terms? And then the last thing is you make sure the shareholders are genuinely aligned. It's not a good time to discover that one founder expected a full exit while another assumed they would be retaining equity and staying involved. So an LOI will not resolve every legal detail, every issue or commercial point, but it should be clear and understood before it's signed. And the aim is to know what you're agreeing to, what remains open, where the deal could still move once the buyer has exclusivity, and where the risks are. So closing thoughts, and then we'll open it up to Q&A. So you're receiving an LOI, it really is a major moment, and it should be celebrated for sure. It's a significant milestone, but it's not the finish line by any means. For many founders, it represents years of sacrifice, uncertainty, and that belief that only founders have before finally being recognized by someone else or another entity that wants to acquire your business. So the excitement is completely understandable. I've been there myself as a founder. But it's also the point where the decisions become critical and have a real impact on what you walk away with and what you give up. And it's a time where if emotions run unchecked, it can cause issues down the line. The headline valuation will attract most of the attention, but the outcome will be shaped by everything that's around it. What's being acquired, how much cash you receive, what risk remains with you, how long you stay, and how you're involved with the business, and essentially how much leverage you give up. Those decisions should never be made in isolation. Co-founders, the board, shareholders, you all need to be aligned. You need to speak to an experienced advisor, get their input. You need to be aligned on what you value, what you're prepared to risk, and what a successful outcome looks like for everybody involved. And then you use leverage while you still have it. Clarify the open points, negotiate the package as a full, make sure the buyer has earned exclusivity before you step away from the alternatives. So an LOI can be the beginning of a genuinely life-changing outcome, but it deserves the exact same amount of care and discipline and judgment that goes into building the business in the first place.
Yeah, I would say the biggest risk is assuming that you and the buyer are on the same page without actually discussing things and assuming, we're going to figure these things out. That's probably the biggest risk. And it's like a relationship, right? At the beginning, everything seems rosy and everything's positive and everything will work out. But there's a real chance that things will get tense. So having this mutual agreement up front in the form of an LOI is critical.
Yeah, emotions definitely come into play. All right, so what just to wrap up, what do founders get from an advisor-led process? So as I'm sure you know by now, or we hope from the previous webinars, is a good advisor does more than just introduce buyers. The real value comes from bringing structure, judgment, and experience to a process that most founders might only go through once, and that could be one of the most important transactions of their lives. It starts by making sure the business is generally ready before buyers are introduced, and from there it's about shaping the narrative, approaching the right buyers, controlling the flow of information, and maintaining competitive tension throughout the process. And as the deal progresses, that role changes again. Buyers test assumptions, new issues emerge. Commercial decisions become more difficult as the finish line gets closer. And that's really, as Georgios has mentioned, this is where experience really matters. We've seen through countless transactions to know, which issues are material, what are negotiating tactics, and what issues simply need to be managed without losing momentum. So having someone who's been through it, before, during these negotiations, these closing price adjustments, can easily just justify the success fees alone on that, on that negotiation alone. And finally, appointing an advisor sends a strong message to the market. Buyers know they're entering a structured process. They assume there'll be competition. They understand they'll be dealing with experienced professionals who know how these transactions should be run. And what that does is it allows founders to focus on the business. It's less distraction for them. It gives them leverage. It gives them access to better decision making and a much greater chance of achieving the right outcome. So to wrap up, hopefully you can start to appreciate the best exits aren't accidents. They're the result of deliberate preparation and disciplined execution. In our experience, the companies that achieve the best outcomes treat exit readiness as a business discipline, as part of their operating model, not just as a thought when you're, thinking about starting to run a process. So better documentation, better team structure, a better operating model, or create more options. They improve the buyer confidence, they reduce founder dependency, they reduce value leakage in the final stages of the process. And the thing I always say is, remember, you don't need to force a transaction tomorrow, but preparation can't wait until the day that you decide to sell. So on that note, I'd love to open it up for Q&A. If anyone has any questions, we'll be more than happy to answer them live. So we have one question. If a buyer approaches a founder directly with an unsolicited offer before they have run a process, how do you help them decide whether to engage seriously, run a full competitive process, or push back for more? Good question.
Okay, I can take a stab. I would say, first of all, most companies do end up, they do receive inbounds. Most companies, more than half the companies do receive inbounds. I would say it's rarely, unless it's a blowout offer, which again, an experienced advisor should be able to give you guidance on whether it's a really good offer or not. But unless it's a really good offer, I would probably always advise to hold off and test the market, at least selectively. There can be a process whereby that party is engaged with, right, while also doing a sanity check for the rest of the market. Regardless, having these conversations without an advisor typically would signal to the other party that there's no competition. So even if that was not true, perception is reality a lot of the time. So that party, when you're on a one-on-one basis, could tend to lowball you or assume that they can get a better deal off market. So generally speaking, it's always better to bring an advisor and do a proper test of the market, even while maintaining that engagement in parallel and not jeopardizing it. That would be my take. Of course, probably I would probably say there's a difference between that, a buyer getting to a point where they submit an LOI versus just an inbound where they're just having informal conversation, right? There's one of the most common situations is, founders having endless conversations for over months and quarters and years with parties that seem interested but never pull the trigger. And a lot of times when the process becomes formal, when there's deadlines that they need to meet or LOIs that they need to submit, then those parties, they tend to kind of, disappear.
How do you help define the DD scope and materiality thresholds upfront so a buyer can't later treat minor findings as an excuse to renegotiate?
Yeah, I'm not sure there's a kind of a clean kind of formulaic version to approach to do this. Typically, minor things, it would be hard to justify, retrading based on minor things. Sometimes a retrade can be triggered by other reasons, and these minor findings can be an excuse, right? And that's where an experienced advisor can read between the lines and understand really what's happening, especially if that advisor has a relationship with the buyer in the past, or may run into that buyer again in the future. Then it's much more likely for that advisor to be able to get to the real reasons behind the retrade if the findings are actually minor. So I would say again, it's very situation specific, but if a retrade happens on the back of minor findings, usually there's another reason behind it. Or maybe it's possible to just push back on that request for a retrade and avoid that retrade altogether.
We've got one more question incoming. Can you share an example of a deal where your involvement in the LOI negotiation clearly changed the outcome versus what the founder would have gotten on their own?
Yes, well, I can look.
Probably every deal.
Look, every situation is different, but what I can tell you is that we've seen situations where the LOI was the as I mentioned earlier, you cannot force a buyer to agree on certain things pre due diligence, right? So a lot of times a buyer might say, "Look, I'm going to hire, due diligence advisors, financial advisors, legal, etc., and do proper diligence under exclusivity. So I'm not able to discuss certain points upfront." So you cannot force the buyer to agree on the things that you want. But we have been in a situation where the buyer was more open to discussing things and less open to discussing things. And in situations where the board and the shareholders were more keen to accept an LOI that was not necessarily fully negotiated versus others who were okay to say, look, guys, let's just do this properly and negotiate as much as possible pre-LOI. And I can tell you that while it's not necessarily a guaranteed negative outcome if you don't negotiate an LOI extensively, yeah, I can tell you that there have been a lot of situations, like a pattern we see a lot, is if you haven't discussed, for example, certain big items at the LOI stage, they tend to be pushed to the very end. Because towards the very end, close to signing, that's when the buyer has the most leverage because they're thinking, the seller is thinking, we're so close to signing, let's just potentially agree to this so we can get to signing, right? So that's, I think, the biggest risk that we see. So whatever's non-negotiated, big items are non-negotiated up front. The pattern and what frequently happens is that they get pushed to the very end, close to signing, and then it's, it gets much more difficult to push back after months and months of due diligence and legal fees and all those.
Yeah, I suppose that experience, understanding of when to push, when to pull, when to hold is critical, and it just comes from repetition. All right, I think it's a good time to wrap up. If you are interested in continuing learning, bear with me. Here is, excuse me. The next webinar is going to focus on closing adjustments and deal mechanics, and then the sixth is on how to structure earnouts and deferred consideration. So we thank everyone for their time today, And yeah, we'll send you the recording and the deck afterwards. We appreciate your time, and we look forward to seeing you on the next one. Thank you very much.
Thank you, everyone.